10 final lessons from Warren Buffett for financial freedom after 50. Have you ever wondered if it's too late to achieve true financial freedom after turning 50? A recent study found that 72% of Americans over 50 fear they'll never have enough money to retire comfortably. Even more alarming, the average 50-year-old has less than $117,000 saved for retirement, nowhere near enough for decades of financial security. But here's something that might change how you think about your financial future. Warren Buffett, now worth over $100 billion, made 99% of his fortune after his 50th birthday. That's right. The world's greatest investor was worth only about $19 million at age 50. His greatest wealth-building decades came during the years when most people believe it's too late to start. The truth is, the conventional wisdom about building wealth after 50 is fundamentally flawed. Rather than requiring complex strategies or lucky stock picks, Buffett's approach uses straightforward principles that anyone can apply, regardless of their current financial situation. In today's video, I'll share 10 powerful lessons from Warren Buffett that could transform your financial journey after 50. These aren't theoretical concepts. They're practical strategies that have created more wealth than perhaps any other approach in history. Stay until the end for Buffett's most profound insight about money after 50. One that contradicts almost everything we're taught about success and happiness, but holds the key to true financial freedom in your later years. Where do you stand on your journey to financial freedom? Type starting or advancing in the comments below to let me know where you are right now. Let me share with you the first powerful lesson from Warren Buffett that could completely change your financial future. Even if you're starting later in life, it's never too late to start. The best time to plant a tree was 20 years ago. The second best time is now isn't actually a Buffett quote, but it perfectly captures a philosophy about investing at any age. This message is particularly powerful for those of us over 50 who might feel we've missed our chance at financial freedom. Here's a surprising truth that few financial advisors emphasize. Warren Buffett made approximately 99% of his wealth after his 50th birthday. That's right. The man, considered the greatest investor of all time, created the vast majority of his fortune during a time when many people believe they're too old to achieve significant financial growth. At age 50, Buffett was worth only about $19 million. Today, in his 90s, he's worth over $100 billion. This pattern isn't limited to Buffett. Ray Kroc was 52 when he purchased McDonald's and transformed it into a global empire. Vera Wang didn't design her first dress until age 40. Colonel Sanders was 62 when he franchised Kentucky Fried Chicken. The evidence is clear. Starting later doesn't mean you can't achieve remarkable financial success. The smart approach isn't lamenting lost time, but maximizing the time you have. At 50, you likely have 15-30 plus years ahead. Plenty of time for compound growth to work its magic. Start by taking advantage of catch-up contributions in retirement accounts, an extra $7,500 in 401(k)s and $1,000 in IRAs for those over 50. Focus on consistent investing rather than trying to make up for lost time with risky bets. Remember Buffett's wisdom. Risk comes from not knowing what you're doing, not from starting later in life. And speaking of knowing what you're doing, Buffett's second lesson cuts through confusion that keeps many Americans from successful investing after 50. Simplify your investment strategy. There seems to be some perverse human characteristic that likes to make easy things difficult. Buffett has observed. This insight is particularly valuable for those of us who feel overwhelmed by the seemingly complex world of investing. The uncomfortable truth is that complexity doesn't equal better returns. Quite the opposite. Studies consistently show that simple investment portfolios often outperform complicated ones over time. Yet the financial industry thrives on making investing seem so complex that you'll pay high fees for expert guidance. Many Americans over 50 own dozens of mutual funds that essentially cancel each other out, creating expensive complexity without better results. Consider Buffett's approach at Berkshire Hathaway. Despite having hundreds of billions to invest, he keeps things remarkably simple. In his 2013 letter to shareholders, he revealed his instructions for his wife's inheritance. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. That's it. 2 investments, not 20 or 30. This simplicity hasn't held him back. It propelled him forward. The smart solution for those over 50 is to streamline your investments. Consider consolidating retirement accounts from previous employers. Replace a collection of overlapping mutual funds with a few broad market index funds. For those who want individual stocks, focus on 10 to 15 quality companies you truly understand rather than dozens you can't possibly track effectively. As Buffett says, wide diversification is only required when investors do not understand what they are doing. This principle of simplification connects perfectly to Buffett's third lesson, one that could save you tens or even hundreds of thousands of dollars in your remaining investing years. Cut investment costs. The most important thing to do if you find yourself in a hole is to stop digging. Buffett has advised, when it comes to investment fees, most Americans are in a much deeper hole than they realize, and it's particularly damaging for those over 50 with larger account balances. Here's the shocking reality. If you're paying just 1% more in fees than necessary, say 1.5% instead of 0.5%, that difference could cost you over $100,000 on a $500,000 portfolio over 15 years. That's not a typo. $100,000 of your hard-earned retirement savings gradually transferred to financial institutions through seemingly small fees. Buffett famously bet $1 million that a low-cost S&P 500 index fund would outperform a collection of hedge funds over 10 years. He won decisively, with the index fund returning 125.8% versus just 36.3% for the hedge funds. The difference? Largely, the enormous fees charged by the complex investment vehicles. The solution is straightforward but requires awareness that many lack. Conduct a fee audit of every investment you own. Look beyond obvious expense ratios to uncover hidden charges like 12b-1 fees, load fees, and transaction costs. Then, systematically replace high-cost investments with low-cost alternatives. Index funds and ETFs from companies like Vanguard, Fidelity, and Schwab now offer expense ratios as low as 0.03%, a fraction of the 1 to 2% charged by many actively managed funds. Do you know exactly how much you're paying in investment fees each year? Type fee aware in the comments if you've checked your investment costs recently or want to learn how to conduct your own fee audit. Now, let's explore Buffett's fourth lesson, which becomes increasingly important as we move into our 50s, 60s, and beyond. Focus on income, not just growth. If you don't find a way to make money while you sleep, you will work until you die. Buffett has wisely observed. This insight becomes increasingly important after 50, when your investment strategy needs to evolve from pure growth to generating reliable income. Here's the reality that many traditional financial advisors miss. Once you're in or approaching your retirement years, how your portfolio generates returns matters as much as the returns themselves. A portfolio designed purely for growth might show impressive long-term numbers, but it can also experience years of negative returns that are devastating when you're actually withdrawing money to live on. Warren Buffett understands this principle deeply. While he's known for his remarkable growth record, Berkshire Hathaway now receives over $5 billion annually in dividend income from companies like Apple, Bank of America, and Coca-Cola. This steady income stream provides stability and opportunity, regardless of short-term market fluctuations. In fact, his Coca-Cola investment alone now pays Berkshire about $704 million in annual dividends, more than Buffett's original investment of $1.3 billion in the late 1980s. The smart approach for investors over 50 is gradually shifting from a pure growth strategy to one that emphasizes reliable income. This doesn't mean abandoning growth entirely, but rather building multiple income streams from dividends, interest, and perhaps rental properties or other passive sources. Look for quality companies with long histories of maintaining or increasing their dividends, known as dividend aristocrats. Consider balancing your portfolio with some bonds or bond funds that provide current income with less volatility. Remember, your goal isn't just to accumulate the biggest number possible, but to create sustainable income that supports your lifestyle regardless of market conditions. After all, financial freedom means having your money work for you, not the other way around. This focus on reliable income connects directly to Buffett's fifth lesson, one that can remove a major obstacle to financial freedom after 50. Eliminate bad debt. I've seen more people fail because of liquor and leverage being borrowed money. Buffett has cautioned, this advice is especially crucial after 50, when the time to recover from financial setbacks becomes more limited. The uncomfortable truth is that debt is the single biggest obstacle to financial freedom for many Americans over 50. According to Federal Reserve, debt levels among older Americans have increased dramatically, with the average 65-year-old now carrying over $38,000 in non-mortgage debt. This burden effectively places a tax on your future, with each dollar of interest paid being a dollar that can't build your wealth or generate retirement income. Berkshire Hathaway's balance sheet reflects Buffett's aversion to unnecessary debt. Despite having the ability to borrow enormous sums, the company maintains remarkably low debt levels. This conservative approach has allowed Buffett to sleep well during financial crises and seize opportunities when others were struggling with loan payments. The solution requires honesty and determination. Create a debt elimination plan with specific targets. Start with high-interest debt, like credit cards, using either the avalanche method, highest interest first, or the snowball method, smallest balances first. For mortgages, consider whether an aggressive payoff plan makes sense given your specific situation. Some financial experts recommend weighing the emotional benefit of entering retirement debt-free against the potential investment returns from keeping a low-interest mortgage. For those already in retirement with significant debt, consider whether downsizing, working part-time, or restructuring your withdrawal strategy might help accelerate debt reduction. Remember Buffett's perspective. Freedom from financial worry is worth far more than material possessions that keep you in debt. This debt-free mindset creates the stability needed to implement Buffett's sixth lesson, one that might seem counterintuitive but has been central to his remarkable success. Don't fear market volatility. Be fearful when others are greedy, and greedy when others are fearful, Buffett famously advised. For Americans over 50, this wisdom is both challenging and potentially life-changing. Here's a reality many find uncomfortable. Market volatility isn't your enemy. It's potentially your greatest ally. Since 1980, the S&P 500 has experienced an average intra-year decline of 14%. Yet despite these regular drops, the market has produced positive returns in 32 of those 43 years. Those who panic during downturns not only lock in losses, but miss the recoveries that historically follow. Buffett's actions during market crashes demonstrate his unwavering commitment to this principle. During the 2008 financial crisis, when most investors were selling in terror, Buffett invested billions in companies like Goldman Sachs and Bank of America. These investments, made when others were panicking, later generated billions in profits. During the March 2020 COVID crash, when the market plunged 34%, Buffett remained calm while others fled the market. For those over 50, the approach is nuanced but powerful. Maintain an appropriate asset allocation based on your specific timeline, but view market declines as potential opportunities rather than disasters. Having 5 to 10 years of expenses in less volatile investments provides a security to avoid selling stocks during downturns. For your growth assets, consider keeping a shopping list of quality companies you'd like to own if their prices drop significantly. How did you react during the last major market drop? Did you sell in fear or see it as an opportunity? Type opportunity in the comments if you've learned to view market declines as potential buying opportunities rather than disasters. This balanced approach to market volatility connects perfectly to Buffett's seventh lesson about protecting what you've built. Protect your assets. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Buffett has famously stated, while this might sound obvious, it reflects a profound shift in mindset that becomes increasingly important after 50 when recovery time for financial setback shrinks. The reality is that after 50, financial defense becomes as important as offense. While younger investors can recover from major losses through time and additional contributions, those approaching retirement have less of both. A 35-year-old who loses 30% in a market crash has decades to recover. But for someone at 65, such a loss could permanently alter their retirement lifestyle. Consider how Buffett structures Berkshire Hathaway's investments. Despite his reputation for brilliant stock picking, he maintains enormous cash reserves, sometimes over $100 billion, that earn relatively little but provide invaluable protection and opportunity during market turmoil. This isn't fear, it's strategic caution. When the 2008 financial crisis hit, Buffett had the financial strength to make opportunistic investments, while others were forced to sell at the worst possible time. The smart approach for those over 50 is creating a properly balanced portfolio with multiple layers of protection. This might mean keeping 2 to 3 years of anticipated withdrawal needs in cash or short-term bonds, regardless of their low yields. It means ensuring adequate insurance coverage for potential health emergencies or long-term care needs. It might include considering inflation-protected securities like TIPS or I bonds to preserve purchasing power. Remember, at this stage of life, avoiding catastrophic losses is often more important than maximizing gains. As Buffett's business partner Charlie Munger puts it, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. This protection of your financial health naturally connects to Buffett's 8th lesson about protecting something even more fundamental: invest in your health. While Buffett isn't typically quoted on health matters, his actions speak volumes. Despite his wealth, he carefully manages his physical well-being, recognizing that all the money in the world is worthless without health to enjoy it. Here's the sobering truth many financial plans overlook. Medical issues are the leading cause of personal bankruptcy in America, regardless of insurance coverage. According to Fidelity, the average 65-year-old couple will need approximately $315,000 for healthcare expenses in retirement, excluding long-term care. No investment strategy, however brilliant, can compensate for a health crisis that could have been prevented. Warren Buffett, now in his 90s, has made deliberate lifestyle choices to maintain his remarkable energy and mental sharpness. He limits sugar, exercises regularly, and prioritizes sleep and mental stimulation. He once joked that he checked actuarial tables and found that the lowest death rates were among 6-year-olds, so he decided to eat like a 6-year-old. Lots of ice cream and soda. While that specific approach isn't medically recommended, his underlying point about being intentional with health makes perfect sense. The practical solution is treating health as an essential investment, not an expense. This means regular preventive care and screenings, which often detect issues when they're most treatable. It means budgeting for quality insurance coverage, including consideration of long-term care insurance or alternatives. Most importantly, it means developing sustainable health habits around nutrition, exercise, and stress management that can maintain quality of life as you age. Remember, financial independence loses its value if health challenges prevent you from enjoying it. The freedom to travel, spend time with loved ones, or pursue new interests requires both financial resources and the physical capacity to engage in these activities. This holistic view of wealth and well-being leads naturally to Buffett's 9th lesson about finding meaning in your next chapter. Find a purpose for your next life phase. In the world of business, the people who are most successful are those who are doing what they love, Buffett has observed. This insight becomes particularly powerful after 50, when many begin questioning what their next chapter should look like. The uncomfortable reality is that many people focus exclusively on the financial aspects of retirement planning while neglecting the equally important psychological and social dimensions. Studies show that those who retire without a clear purpose often experience depression, cognitive decline, and even shorter lifespans, regardless of their financial situation. Look at Buffett himself, still actively working well into his 90s, not because he needs the money, but because he genuinely loves what he does. He's often said, "I tap dance at work every day." Similarly, his business partner Charlie Munger remained actively engaged in business and intellectual pursuits into his late 90s. They understand that purpose creates happiness far more effectively than leisure alone. The solution isn't necessarily continuing traditional work, but rather finding meaningful engagement that provides structure, social connection, intellectual stimulation, and a sense of contribution. This might mean phasing into retirement with part-time work, consulting, mentoring younger professionals, volunteering for causes you care about, or pursuing entrepreneurial ventures without the financial pressure of your earlier years. Consider starting this exploration before retirement by trying on different activities. Volunteer in areas that interest you. Develop hobbies that could become more significant, or take courses in subjects you've always wanted to explore. The goal is to create a vision for this next phase that's as thoughtfully designed as your financial plan. As Buffett has demonstrated, a life of purpose isn't just more fulfilling. It can also be longer and healthier, allowing more time to enjoy the financial freedom you worked so hard to achieve. This focus on genuine fulfillment connects perfectly with Buffett's 10th and perhaps most profound lesson: lie below your means and enjoy the simple things. The happiest people do not necessarily have the best of everything. They make the best of everything they have. Buffett has wisely noted, this perspective has allowed him to maintain extraordinary contentment despite having the resources to indulge in virtually unlimited luxury. The surprising truth is that beyond a moderate income level, research suggests around $75,000 to $95,000 annually, additional wealth produces diminishing returns and happiness. Yet many Americans continue sacrificing time, health, and relationships, pursuing ever-increasing consumption that doesn't actually improve their life satisfaction. Warren Buffett's lifestyle choices offer a powerful alternative model. Despite being one of the world's wealthiest individuals, he still lives in the same modest Omaha home he purchased in 1958 for $31,500. He drives ordinary cars, eats simple meals, often at McDonald's, and finds joy in playing bridge, reading, and spending time with people he loves. This isn't deprivation. It's liberation from the exhausting treadmill of constant consumption and status seeking. The practical application for those over 50 is redefining success and luxury on your own terms. This might mean downsizing your home to reduce maintenance and expenses while increasing freedom. It could mean carefully evaluating which expenses truly enhance your well-being versus those that simply inflate your lifestyle without adding real value. Consider creating a joy audit of your spending, examining which expenditures genuinely increase your happiness and which are driven by habit or social expectations. Many discover their greatest pleasures come from relationships, learning, creativity, and contribution, all areas where spending more doesn't necessarily create better experiences. Remember Buffett's perspective. I'm not interested in cars, and my goal is not to make people envious. Don't confuse the cost of living with the standard of living. True financial freedom comes not just from having enough, but from being content with what you have. We've now explored Warren Buffett's 10 essential lessons for achieving financial freedom after 50. It's never too late to start. Simplify your investment strategy, cut investment costs, focus on income, not just growth, eliminate bad debt, embrace market volatility as opportunity, protect your assets, invest in your health, find purpose beyond work, and enjoy life's simple pleasures. These aren't complex formulas requiring an MBA to understand. They're timeless principles that have helped create one of history's greatest fortunes, and they can work for you too, regardless of your current financial situation. This week, I challenge you to take one specific action based on what you've learned today. Perhaps review your investment fees, start a debt elimination plan, or create that crash shopping list of quality companies you'd love to own at lower prices. Even small steps, taken consistently, can transform your financial future. Leave a comment saying financial freedom. If you're committed to applying at least one of these lessons in your own life, I'd love to know which principle resonated most deeply with you. In our next video, I'll share Warren Buffett's ideal investment portfolio for those over 50. The specific mix of assets that can provide both growth and security during your most important financial decades. Remember what Buffett himself said, someone's sitting in the shade today because someone planted a tree a long time ago. At 50, 60, or beyond, you still have time to plant those trees and perhaps enjoy their shade sooner than you think. Financial freedom isn't about your age or your past. It's about the decisions you make today and every day going forward.